GM, just a quick one before we get going. So, as you know, the Blockmates podcast is for informational and entertainment purposes only. Certainly shouldn't be considered as financial advice. We have absolutely no idea what we're talking about half the time. So, any investment decision you do make should be based on your own research and your understanding of the risks involved. One more thing as well, there's around 50% of people who listen regularly who aren't subscribed yet. So, if you please could just do us a favor and hit the subscribe or the follow button or the like button, helps content grow, helps us grow, helps it reach more people like yourselves, and it means the world to us as well. So that's the last I'll ask of you. So yeah, let's get to the episode.
And we're back. Good afternoon, good morning, good evening. Hello, everyone. We have an interesting one today. We have Chiel from Florence Finance. Real world assets, a big narrative that we will see come to light into 2024 particularly. I'm very enthusiastic about real world assets and where they're taking us. There's a lot of momentum with a number of players in the market at the moment. Welcome, sir. It's good to have you.
How Thank you doing? Very much for having me. Really appreciate you taking the time to talk to us. It's fantastic.
No, it's a pleasure. It's an absolute pleasure. I think you guys are doing something quite extraordinary. I'm going to let you tell us what it is that you guys are doing primarily, and then tell us a little bit about yourself.
Great. Let's get into it. So my name's Chiel. I run a project called Florence Finance. We started building this at the height of the last bull market. It was driven primarily by a bunch of people who were early to crypto, who had made a fair bit of money in crypto and wanted to leave that money in crypto. But obviously with the bear market looming, we needed a safe haven asset, preferably yield bearing. And at the time, USDT was the only thing that kind of fit that bill, or Maker with DAI. And, the thought about USDT was as thick then as it is now. And Maker had just been through, an existential crisis during the COVID bust. And so that didn't really exist. And so we set out to think about what we could build as a euro-denominated, positive yield-bearing instrument. And we did a lot of work around whether we could build a euro-denominated DAI equivalent, so a multi-collateralized stablecoin. And the TLDR of that was that was going to be a very big challenge, both technologically, because Maker is actually quite a complex protocol, but also from a legal and legislative perspective. But we discovered that what we could do is we could basically tokenize a private debt fund quite easily. And given my background as a banker and some of the other founders as well, that is something that we were ultimately very familiar with, and that we thought we could do on a reasonably shoestring budget. And we thought that would really work, because what it does, if you do that and you do private credit, is you basically get exposure to a part of the credit spectrum which gives positive yields through the cycle, which at the time, remember, government yields were all negative. And so what is currently on vogue in the whole RWA space, i.e. tokenized treasuries or tokenized government bonds, back then was a loss-making proposition. So it didn't work. And, I would think or say that, it's anybody's guess whether, rates go back down to zero and whether those products or services will be, as interesting to the crypto ecosystem as they are today. Whereas what we've done, where you basically take an area of the credit spectrum that provides, positive yields throughout the cycle and that is not impacted as much by, whatever the Fed or the ECB is doing, then you can kind of bring, real yield on chain. You can do that in whatever currency or denomination you desire. We just chose to start in Europe because that's our backyard. And, we thought that would have value. When we started building, there was a lot of yield products, Terra Luna, there was Celsius, there was BlockFi, there was a whole bunch of people, and they were providing yields which were, mostly in excess of what you can credibly get in the real world by taking credit risk. And so it wasn't at all crystal clear at the time that our product would, have mass market appeal. We knew it had appeal to us because we didn't want to put our money into BlockFi or Celsius or Terra Luna, but there was a lot of other people that obviously did, and with the benefit of hindsight, that wasn't a very smart idea. But certainly when we started building, I'd have to be honest, I say we didn't know what that future would look like. Fast forward 2 years now, where we are today, RWAs are flavor of the month. There's a whole bunch of different type of proposals or projects out there. Ours is but one. I personally like the projects that try to solve real world problems. So, things like Goldfinch for the emerging markets, or Blue Jay in Asia, or what we're doing in Europe, those are trying to address real world funding needs. They get, proper yield. You do take real credit risk. So, that's the flip side of that same coin. But at least you know what you're getting into, because a lot of these protocols try to at least be quite transparent about what you're buying. The other flip side of that same coin is that obviously private credit is not liquid like the treasury market is. So there is a liquidity thing that you need to work around if you're going to invest in this type of thing. So it's by no means a stable coin. It is a proper participation in a private debt fund, just in tokenized form. And because it's tokenized, it's freely tradable and composable in the kind of secondary DeFi market, and that's the true innovation here. Right?
So that's definitely a hell of an introduction in terms of what it is that firstly you guys are doing. So if I could ask you in very simple terms, in one paragraph, what is it that Florence Finance is doing? What does it say on the tin?
So
as you
Florence
so eloquently
primarily, Florence is primarily built for people on chain that want to park their money in a kind of safe haven type asset, euro denominated, yield bearing. Yeah, so it's the crypto equivalent of a savings account. Very boring, very stable. It doesn't go to the moon, but it's supposed to also not lose your money. And by making it as transparent as possible and as simple as possible, what we try to do is we try to pass through the maximum amount of underlying yield that we generate to the people that invest in the protocol. So that is the sole purpose of this thing. And if we can get enough people to start using this, even if that happens to be in a cyclical way, so you only use this thing in the bear market, and then in the bull market you take your money back out and you start to deploy it into risk assets again, then we will, on the other side, i.e. in the real world, be addressing a real world problem. There is a very neat counter cyclicality between the crypto cycle and the banking credit cycle, i.e. when we are in the bear market and everybody's parked up in stables, then usually money is quite tight in the outside world. And so the fact that there is now this crypto liquidity looking to gain yield in the real world is a great outcome for our partners, our lending partners, who at that point in time are struggling to get funding from other, call it more traditional sources. And when money is not tight, and that's usually when the crypto markets are also in a bull market, then they can get money on every corner of the street and they don't really need the crypto's liquidity. So there's a very neat kind of counterbalancing thing that we do, which helps these SME lenders to get to funding. It's an alternative source of funding for them. But the tin, it's primarily made for on-chain, for generating yield and parking up in a safe haven asset.
And how do you plan on doing that from a collateralized perspective? What collateral are you guys planning to use in order to afford people that opportunity?
So what happens in our protocol is at this point in time, because you have a cold start problem whenever you try to build something like this, your chicken egg problem, right? So you first need to have some loans, some tokenized loans, before people can actually participate, right? So what we've done in the beginning is we've raised money from people who are fully doxed and whitelisted and KYC'd and AML'd, and put that money into the vaults. The money gets taken out of the vaults by Florence, the delegate, and given to our lending partners in order to underwrite their lending activity. Yeah. And when that happens, the tokens are created in the vault, and you have a receipt token with the person that funded it. And those receipt tokens are fully fungible and tradable. So that's been done. So now this thing is kind of primed. There is a bunch of loans in the vaults, and the corresponding loan vault tokens are in circulation, and they can now be bought by everybody and sundry. And as those loan vault tokens get bought up, and so basically these are people stepping into the shoes of the people who originally funded the loan, those people will be getting the money back, and we could be able to recycle that and build the loan book slowly. That is, call it the slow way of building the loan book. The faster way, which I think in the next phase of growth will become relevant, is to take existing loan books, bring them on chain, tokenize them, so no money changes hands. These loans have already been funded, are in existence. All we're doing is bringing them on chain. And by bringing them on chain, you provide access to secondary liquidity, and therefore you make them tradable. So that is the next phase of growth, which will be less dependent on actually raising new money. But at that point in time, you'll be able to show people that, look, this thing exists. There's a real marketplace for this stuff. People are interested in having this. And so, if you took your private debt fund, which already exists, but which is totally illiquid, right, and you bring it on chain, then we can get you into that same liquidity, which we have generated by this small thing, which we've built, call it the hard way. And so that's what you're seeing now with the bigger lending protocols. So rather than raising fresh new capital and doing the hard yards of making the loans, doing all the credit work, making the loans, what they're doing is partnering with existing, SME lenders or other factoring lenders or asset-backed lenders, and bringing their existing books on chain. And that is what's going to really drive the growth of that sector. And then it is what's going to happen is there's going to be a lot of these assets on chain that are more and more liquid, and people will have more and more choice as to how to and where to park excess capital whilst garnering a yield. And that to me is going to in the last cycle, a lot of people would park up in USDC or USDT and forego any yield on that, right? And I think that's going to end with the advent of these real world asset alternatives, where you can take your USDT or your USDC or your Euro stablecoin and basically, generate a yield on top of the fact that your underlying exposure remains Euro or dollars.
Why do it all on chain?
Yeah, so this is the $1 million question. So the premise of that is where we started with that the kind of counterbalancing thing that exists between the crypto world and the real world. So in the real world, there are all kinds of things that require credit or liquidity, and if there's no real need for crypto to be involved, then why would you do that, right? But like I said, the credit has a cycle in the world, right? So there are times when money is tight, and there are times when money is not so tight. So right now, with interest rates being high, money is reasonably tight. And over the last year, while crypto was still in the bear, when interest rates were rising, money was getting tighter and tighter. There was a lot of excess liquidity in crypto, which could alleviate some of that tightness. And so by bringing crypto together with the credit cycle, which is, you can basically flatten out or even out that cycle, and by providing an alternative source of funding to the real world. So that's the neatness. You don't need crypto to do this. Effectively what we're doing is we're tokenizing private debt funds. Private debt funds exist with or without crypto. But there is added value because of that countercyclicality.
Do you believe that in light of the comparative between it's quite amusing how we term the real world versus the crypto world, like like they are two separate things, but we know that they're not. But for the sake of conversation, we refer to them as that. But do you believe that even though there is that separation, there isn't really a separation, and it's just a matter of time before it does just become an exercise of how do we access liquidity in the easiest form that we can? And I think you are 100% correct in saying that there's a lot of liquidity that was essentially sitting idle that could have been put to good use. But because people were fearful, or whatever the reasons were, we can kind of speculate around that. It wasn't. Do you believe that might be a potential market fit for Florence Finance, in that we are providing potentially this safe haven, even when things aren't great, whether it's credit crunch, whether it's a bear, and that might translate into more fluidity around how capital moves in and out of not only the blockchain and the real world, but primarily into Florence Finance?
Yeah, so this is a much bigger theme, and I actually wrote a piece that you can find on the Florence Finance website as a blog post. It's called The Bloodletting. And so I believe that the credit cycle is not because of the moon phase or because of whatever. It's not some natural phenomenon, right? It is a consequence of the fact that Tradfi is hugely over-levered. Yeah. And that leverage ebbs and flows with interest rate cycles. But if that over-leverage was not as much, then the cycle would be less pronounced. And so there is an optimum of leverage. Some leverage is good, too much leverage is bad. That leaves a cycle that is manageable. And what I would argue is that we are at the point where the cycle is becoming more and more unmanageable for normal, small and medium-sized businesses and people. And so what needs to happen is the Tradfi system as a whole needs to deleverage. And what happens in our protocol does not use leverage. It has a loan to deposit ratio of 1, right? Which is not the most efficient way of generating yield, but it's also, there's no cyclicality induced by leverage. And so what I think happens over time is, on the crypto side of things, we do introduce some, moderate forms of leverage. And on the TradFi system side of things have to deleverage. And that means de facto, money has to move from TradFi over to crypto, and the two kind of level out. That's a process. So I'm not I don't believe in some kind of cataclysmic end to the TradFi system. It's not going to implode. It's not going to explode, none of that. But what's going to happen is people are going to move money to where it is safer, where it is more within their control, and where it is not rehypothecated and over-leveraged, as they start to understand the problems that are abundant, I think, in the TradFi system. I mean, it amazes me, having looked at what just happened in the US with all these small regional banks, and the government basically stepping in and guaranteeing retail deposits, when everybody knows that the federal deposit insurance guarantee is impossible to uphold, and people still have money in these banks, right? I mean, I, for one, a long time ago took the decision that I don't want to have my funds, not more than what I need to pay everyday bills, stuck in some kind of over-levered fixed income hedge fund called a bank, right? Why would I want to do that? Why would I want to sponsor that endeavor? But people don't get it yet. So I think that realization will rise. As it rises, there'll be more and more people coming into crypto, and that won't mean the end of banking. It'll just mean that they have to adopt to that new reality, where people aren't willing to put deposits or their savings into some over-levered fixed income hedge fund.
I like the fact that you refer to banks as fixed income hedge funds.
It's what they are, right? I mean, they run 20 times levered fixed income book.
I think it's a lot higher than 20 for some of them. I mean, I think that's the reality.
Right now it's between 10 and 20, right? It used to be more than 20 prior to the previous financial crisis, where banks could really be run with, call it, core tier one equity of between 3 and 5%. But those days are over, right? Most banks now run core tier one ratios of between 8 and 12%. And so, that's kind of 10, 11 times leverage. And then sure, there's some chicanery, and not all of that core tier one is actual equity, but it's come down a lot. So, but I still don't think we're there. I still think there's too much leverage in the system.
Mm. So do you think that in terms of where we are now, in terms of like the crypto space and real world assets, and obviously, speaking specifically to what it is that you guys are doing, do you believe that the holistic market fit and the idea around bringing real world assets into the blockchain environment is something that will reach a critical point of kind of like no return, where it actually becomes like almost like the way to do things? Or do you think it's going to land up being almost like an experimental thing for, quite an extended period of time? I think the question's more around, will the incumbents buy into this idea and join the party, or do you think there'll always be a kind of like a resistance around it?
So I have the view, and this is from experience, right, that a lot of what we do in crypto today and what we've done over the last cycle is still quite experimental. Because a lot of what we do on chain is by definition quite inefficient and quite expensive, right? Especially if you built on ETH, and most of DeFi was built on ETH, with gas prices being what they are, none of this really works from a kind of, $100 or $1,000 deposit in a savings type product, right? I mean, you need to be some kind of ETH whale before that starts to make any type of sense. Yes. And so, we really are building these things for a future where, these layer twos or whatever comes after that, can deal with transactions at speeds and at costs that equate to what we can currently do in the Tradfi system. And we are not there today. So we've moved our protocol to Arbitrum. That is a huge step in the right direction. So now instead of tens of dollars to do a transaction, it costs between 5 and 20 cents to do a transaction. That's manageable. It's still too much, right? It's still more than a SEPA or an ideal payment for most European banked people. But at least you can start to see the light at the end of that tunnel. Then the other thing is that, a lot of the RWA space today and a lot of what's being hyped is around tokenized treasuries, right? That is a super simple product to build. It made no sense to build it 2 years ago when yields were negative on treasuries. And now when yields are at their highs and, all-time highs for the last decade, they're very appealing. But the question is, how long do they stay there? Right? And how appealing are those products if we go back to more reasonable levels? But none of that matters in crypto because it is so fast paced, it is so narrative driven that, again, we've used this opportunity of high yielding treasuries to build out all these RWA protocols, tested them at scale with a whole bunch of people. And, whatever that yielding product of the future is, we now know how to bring it on chain. And, we've experimented with it at scale. And that to me is the value of what is being built. Are these products ready for mass market? Not yet, I would argue. But is the experimentation valuable nonetheless? 100%, I would argue. Now bring that back to Florence. I look at the world where, there is still, I think even in the Netherlands, there's 400 billion of retail deposits sitting at idle at banks. These people are basically captive. They have no other place to put their money. Money market funds are less of a thing in Europe because you obviously have segregated government bond markets. There's no European bond market where you can just park up your money, and not everybody in Europe, has a a brokerage account because it's a lot more expensive than it is in the US, and we don't have Robinhood and those kinds of app type services. And so there really is this captive thing going on, and the banks are taking enormous advantage of that. And we need to build a better alternative. That to me is what crypto is all about, right? It's not about changing the system that is, it's about building better alternatives. That's going to take time. And I think, before Florence can credibly be a real alternative for the masses to put their savings, we have a lot of, water that needs to pass under the bridge. We have an awful lot of growth to do. It needs to become a lot more stable, a lot more diversified. But if we can pull that off, then, I think it has, mass market appeal. And there is, it's something that the world should have in Europe and that it doesn't currently have. And if we can build it on crypto rails, and those crypto rails become cheap enough and easy enough to interact with, then I think this could be a really good thing. But are we there today? No, I don't think so. I think that's going to take a lot of doing, and that's what we're doing, right? We're building this stuff. We're experimenting with it. There is the great thing about the crypto universe is that it's almost self-funding, right? So the people in it, decide where they want to spend their time, where they want to spend their money, which projects are worthy of their attention and of further funding. And so it is a very organic way of finding the efficient frontier of what needs to be built by us, for us.
Yeah, I agree. I think and you stated it quite nicely in terms of and it's great to see that you have awareness that ultimately, a lot of this is an experiment. It doesn't mean that it's not a bad thing that it's an experiment, because we're not going to grow, as a species if we don't experiment and try different things. And I think a lot of us are under the belief, and we're striving for something that's a lot more efficient and a lot better. And I think there are still a lot of things that we need to do and kind of reflect on before we get to that point. But I think the real world asset, just stepping back and kind of looking at it from a holistic perspective, and there's a question here, and the question is that, and it's kind of leading on to the efficiency of capital is very much dependent on how it flows, from point A to point B, and how you can access it, but more importantly, how do you actually put it to use? And I think what blockchain would theoretically do is actually expedite the whole process. I mean, we see it with lending and borrowing. It's kind of I don't need to go to a bank manager and fill out a form. There's a contract in place that allows me to actually initiate said process by providing collateral and then borrowing off the back of that collateral. And if I don't pay my loan off, then there are consequences. Yeah. So I wanted to just ask you, is that what it is that you guys are building, and just kind of looking at it from a holistic perspective?
So it's a different thing, right? So take what happened in crypto, right? So we were running this experiment, and the experiment, it turned out, was most efficiently run at scale through, call it, all kinds of, gambling and casino type activity, right? And so that led to the creation of all kinds of, financial Legos, I call them, so building blocks of the future, which were tried and tested in this enormous, token casino that we created, which is fantastic, right? And so there was games to be played, money to be won and lost, but what was happening in the meantime is we were testing all these, financial building blocks of the future at scale, at size, at volume, in real time, right? So what comes out of that is, automatic market makers, balanced pools, all kinds of, protocols, new blockchains optimized for XYZ, and all of that is a continuously, evolving landscape. And so we're now at the phase where we've got all of these, building blocks, and we now need to plug them into the real world. Obviously, as long as you're doing everything on chain, then that's super efficient and it's super cool, but there are limitations to what you can and cannot do there. So What you're discussing is basically fully collateralized lending. So, if I have $100 worth of Bitcoin, Bitcoin has a certain volatility, I could probably lend, 60% loan to value on that Bitcoin. And if the value of Bitcoin drops to below 60% of, then it gets liquidated and, I basically paid off my loan. That works, but you obviously need the collateral. That's not how the real economy works, right? If a lender or a borrower comes to a lender and says, look, I need to borrow, $100,000, then they typically don't provide $100,000 of collateral. They may give you a first lien over their whatever mortgage or their inventory or all that kind of stuff, but it's not typically fully collateralized. The actual obligation of the borrower to pay back the loan plus interest is the collateral. And so when we say fully collateralized lending, what we mean is that of all the loans that we have outstanding, that they are all in good order and that they have paid the last interest term, and there is no inkling that they are in any kind of default. Once they do go into a default, obviously that changes and we have to take them out of what is the collateralized pool, and we have a whole process for all of that. So we won't get into that, but that is how we think about collateral. Collateral is that we have no indication that the people that lent money from us will not pay that back plus interest. And the moment we do have such an inkling, then obviously we need to do something like that, and then we basically charge that to the pool as a credit loss. So it's a very different thing, and it is the bridge that we need to cross if you want to connect what we built in DeFi to the real world. And there's kind of no two ways about that. So it's a different thing, and okay. They will both coexist, right? I mean, there will be a world where people can borrow cheaply against good collateral that they have, which is already available in DeFi. Protocols like Aave or Compound or what have you. You can do that all day long, right, and twice on Sunday. But this is a different thing. This is a very different thing.
I can't wait to see how this practically plays out. Not only with obviously the way that Florence Finance is approaching it, but just in general around real world assets. Tell us please about what you guys are doing presently and what your roadmap looks like, and what's ahead for what it is that you guys have done. You've told us where you've come from and the road that you've traveled. What does the road look like ahead?
Right. So just to kind of put it all in context, so we started building this thing on ETH. That's where you build. We ran into the gas fee problem. We waited for the layer 2 landscape dust to settle a little bit. That kind of clarified that the right place for us to go next was probably Arbitrum. We spent the last 6 months migrating to Arbitrum. That migration is now complete. 95% of the loans outstanding is now running on Arbitrum vaults, which enables people to now participate, at a reasonable cost, if you will. And now we need to scale. So we are currently running a program where early adopters, through the minting of an NFT, can earn all kinds of points by participating in the vaults, testing the protocol, getting other people involved. And if that goes well, then hopefully we will be able to do a listing also on Arbitrum at some point in the very near future. With that listing, we will have a liquid token, which we will then be able to use to drive adoption through staking rewards. So that'll be the next wave of kind of adoptive growth. And the whole goal here is to get to a level of TVL where the protocol can sustain itself from a very small portion of the net interest margin that the underlying loan portfolio generates. So if the underlying loan portfolio generates between 7 and 10% interest, we think that we should be able to make that a sustainable business if we keep 10 to 15% of that interest generated at a TVL of anywhere between 30 or 40 million dollars. So it's not that far away, and once we get there, then we will have proven to the world that there's enough people that care about what we're doing, B, there's enough people that are willing and able to fund what we're doing and are happy with the return generated in that manner. And then we can basically, just build it organically to whatever it will be. And in my mind, what we do is a regional thing, i.e. it is different in Germany than it is in France, than it is in the UK. All these credit markets, especially for SMEs, are actually quite different. So it is definitely feasible for us to, do a bunch of markets, but each market will have its own, call it idiosyncrasies, and you will need to conquer that market, both on the client, on the funding side, as on the, call it credit partner side, one by one. So for us, we'd love to do a few more European markets. I would really like to take on a more eclectic, credit-starved market, call it in Eastern Europe, or let's say Turkey, where credit is obviously tight, and there's a lot of need. And if you can do something with hard real-world assets as collateral, so for instance, equipment leasing or things like that, in that type of environment, then again, you're solving a real problem with crypto liquidity. And that to me is always the great thing, right? Where you can actually be doing some real world good with money that is looking to get a decent yield. And if you do that in a safe and responsible manner, you're hitting two birds with one stone. And that's sort of always what we're trying to do, right? We started with SMEs. That's something that's dear to my heart. I like what Goldfinch is doing in the emerging markets just as much. But it's just, you can't do everything all at once. So we started in the neck of the woods that we know best, which is the Netherlands. But the plan is to grow geographically.
So, I was going to ask you what the long-term vision is, and I think you've partly answered that question. But what is the kind of like the long-term vision around this thing? Is it to get $1 billion in TVL and to be able to access all these kind of markets and find where that value lies? What does it look like for you today?
So if this is successful, what we end up doing is democratizing credit creation. So right now, 80 to 90% of all credit is distributed through the banks. So people have to go to the bank and beg for money, right? The banks are more and more kind of pulling back from the lower echelons of lending. They like to do bigger and bigger loans because they have more and more regulatory and other costs which they need to service, and so it only makes sense for them to do the bigger stuff. So the threshold of participation in the bank-based credit economy is going up and up and up and up, and so there's more and more people that are falling below that threshold. Those people are being served by fintechs, so startups that are basically specialized and are much more efficient at sourcing and managing that type of credit than the banks ever were or ever will be, right? Mm-hmm. Those people need money. And if we can get them money, then slowly but surely, they will be able to outcompete the banks. And basically that bar, which is now the bar for exclusion, becomes the bar for inclusion in the more efficient, decentralized and democratized credit economy run by a multitude of fintechs, each with their own specialty, with their own customer base, with their own ideas about how you should do that. And that to me is a much better world than a world that is dominated by too big to fail and ever growing banks that are basically excluding more and more people. So to me, that is what defines success. We are but a small contributor to that. It is a whole ecosystem, and facilitating that ecosystem to basically take market share from the banks is the longer term goal.
If you could come up with an idea for a real world asset play in the crypto space besides what it is that you're doing right now, what would that look like as kind of like as a secondary project, if you could do one and there were two of you?
To me, we have now focused on SMEs in the Netherlands, but the SME funding gap globally I've written another blog post about this on the basis of a World Bank report. It is actually staggering the amount of people, the amount of credit that is not being serviced, that has no access to credit.
Yes.
Even in the developed markets. I mean, people think this is a an emerging markets problem, but it's not. It is not. And then if you combine that with how important SMEs are in terms of jobs and in terms of GDP, in most developed economies, SMEs are 60% of the jobs, and close to 50% of non-governmental GDP. And so this is a massively important societally important sector that is being starved of credit. And that is a crime, right? And it needs to be solved. So I literally do not believe there is a bigger problem that needs to be addressed urgently on this earth. So I am 100% committed to this. There's no second best in that regard. Yes. It's a global thing. So whether you're addressing that problem in the emerging markets, or you're doing it in Asia, or you're doing it in South America, but it is one of the biggest things that we need to address. And the current system has very little incentive to reverse the, call it, direction of travel of ever growing, too big to fail financial institutions. It's sort of there's no way back, if you will. So we have to do that separately, and this is why I hope that all the effort and time and hype that has been created by all the stuff that is surrounding the tokenized treasuries slowly finds its way back into that which is real and which makes a real difference, which is more the neck of the woods, or the end of the credit spectrum where I am more focused. Which is, instead of funding governments, we need to fund the real economy and real people.
Yeah, I love that answer, and it's like I live in a part of the world where innovation around SMEs is key to the survival of individuals that are living from hand to mouth, literally. You got people living in the ghetto, and those 100%. People, and those people really do need that kind of thing, and they've got great ideas. You've got people who want to own businesses and just don't have access to that funding, and it's just interesting that you do have that perspective, and I totally agree with you, and it's great to share that passion that you have. It's tangible. It's obvious that you're very passionate about it, and and it's important, because I think what happens is that it's very easy for us to get caught up in what it is that we're doing for ourselves, and we don't really, obviously it's important. We've got to take care of our own and our bills and the rest of it, but it's important to 100%. Be able to do that in the context of, how is it benefiting other people around that? And I think for me, it's what's really critical in this thing, and what I'm always curious about is, do we in the crypto space ever reach a point where it actually changes from, okay, so people are talking about how institutions are interested in crypto and blockchain and the rest of it. Do you think that's an interest around trying to access this kind of dormant capital that's moving in and out of crypto? Or do you think that there is, obviously you believe what it is that you're doing, it's obvious, but do you believe that institutions look at it the same way that you're looking at it at the moment? Or do you think they just see like an opportunity to make money out of retail or other individuals?
I think it's both, right? So I think we have to give ourselves some credit in the crypto arena, that a lot of the people that have made money, within the crypto realm, are also the angels that are funding activities like mine, right? And so there's a whole bunch of people that funded this project, and I didn't tell them any other story that I'm telling you, right?
Yes.
So they know that if they want a pure number go up meme thing, then this is not it, right? this is a different endeavor, and we did get funded, and I think we will continue to get funded, but it is a different story that we're trying to tell. I think as crypto matures, as the meme stock culture kind of flattens out a little bit, people are going to become more and more serious about building stuff that matters. That said, going back to the conversation we were having earlier, it's still very hard to build stuff that actually matters and works because, from a technological perspective, we are still some way removed from this being ready for mainstream, both in terms of, call it volume, but also in terms of interoperability with, banking rails, et cetera, right? Today, to do stuff on chain is still, beyond the realm of most. Most people that have exposure to crypto have it in some centralized exchange account, and they swipe left and they swipe right, and numbers go off and confetti on the screen. But they've never signed a transaction on chain, right? I mean, that is a very small minority that's actually doing that. And mind you, it's not without risk either, right? I mean, it's dangerous out there on chain. So I think it still requires a little bit of time before we can actually get this ready for mainstream. But all the time, we are building this stuff out, building the relationships. In a business like ours, you do have to build these relationships with these real world lending partners, get them comfortable with the fact that they're taking on crypto money. The conversation today is already so much different than it was 2 years ago. Yeah. I won't even begin to explain to you how hard it was for us to get.
So how different is it? Please share with us the conversations that you had 2 years ago.
My first conversation with our first lending partner, Swish Fund, which is a very renowned kind of small lending operator in the Netherlands. They make TV commercials. They lend to mom and pop stores. Very short duration, a couple of thousands, maybe up to $20,000-$30,000 a pop. And they have a very large, very diverse kind of book of credit, and they've been managing that exceptionally well, even through the COVID crisis. No real credit losses, et cetera, et cetera. So we, through our partners and fellow founders, know the people and the founders of that business quite well. And so we sat them down and we explained to them what we were going to do. And they're obviously always in search of funding. So the first reaction is, well, Chiel, if you can get the money, we're going to keep talking to you, right? But to be honest, we're not that sure that anybody really wants to take money out of this crypto thing, because it all feels a bit, dodgy and this, that, and the other. And so we said, that's fine. We'll cross that bridge when we get there. We will build this thing. We'll raise a bunch of money. We will underwrite this first loan. And then why don't you go talk to a bunch of your the people that you lend to, and explain to them that this is where the money comes from, and how do you feel about that? And the feedback was incredible. So at the lender level, they were quite worried about the perception, but at the actual SME level, everybody's a lot more comfortable with crypto than the actual lenders. And even worse, we obviously also talked to a bunch of banks. They wouldn't touch what we're doing with a 10-foot pole, right? They think it's absolute heresy. So this is going to have to change with time, and what it's going to take is good operators, i.e. people that are not fumbling the ball, that have good intentions, that are not stealing from either customers or clients, to show that you can make a difference, and there is liquidity in crypto that wants to aid funding the real economy. I mean, that's a good story. If you can just show that unequivocally, and you can make it transparent in a way that regulators and whoever else wants to have an opinion can take a look at it and say, well, whatever's happening here, they're not doing the world any harm, and the money is coming from people who are trying to do good in the world, then I literally don't see how anybody could frown upon what we're doing. But it is going to take a long time before people get there. And every time we have a Celsius or a BlockFi or an FTX, it's kind of 2 steps back, right? And so we need to have less of those and more of these.
But surely now the interest that BlackRock and all these asset management companies are showing in the space is obviously contributing to the acceleration of exactly, the case that you stated. It's like, I think it's made it a lot easier. I think it also comes with its own challenges, and the traps that come with, bigger players coming into the market and how they play a different game, and then it's going to change. Totally. Yeah.
So the real question is whether we will be able to retain a lot of the, call it libertarian premises that, a lot of the crypto world was kind of the way we set out, right? So correct. Self-custody, not your keys, not your coins, ultimate control, ultimate privacy. What you're seeing with the stable coins already, and also with a lot of the more permissioned DeFi platforms, so the bigger institutional platforms, they're all being permissioned, fully KYC, KML'd. You have to comply. And so where that balance ends, whether we end up all being completely captured with, the system that is, or whether we can actually move the needle a little bit using this new tech, right, to make it a little bit more free and a little bit more self-custodial and a little bit less, ever over-levered and rehypothecated, that is going to be the true test. Nobody knows that today, right? I mean, we're all just trying our little bit and, trying to stay clear of the law. And, today we still have some, call it license to operate and experiment. But, there's plenty of people out there saying things that would, make that very hard. In the US, arguably, it's already extremely difficult. So it is my hope that they retain that, call it, sandbox, I like to call it, where people can experiment. As long as it's not too big and we're not doing anybody any harm, then let people try stuff out, right? We're doing. And then once we get to, 100 million or a couple of 100 million at TVL, then that would be a good point at which you want to be kind of upping the ante a little bit about how and what we should comply with. But until that, to kind of slap on all this compliance crap, it just kind of stops you from getting out of the gate, right? So it's much better to do that at a later date. I think in Europe they're striking that balance, sort of. In the US it's not clear, but I think in general a lot of builders in crypto take the view that we don't ask questions, we just build, and then if somebody wants to slap us on the wrist, we'll deal with that then and there. And I think that's the right thing, and we need much more of that. I love the conversation that's going on on Twitter with all these the guys, the accelerationists, so the Musks and the Jeff Bezoses, that just basically say, we need more people to experiment and build, because, if we're going to wait to change the system by casting a vote either blue or red, I don't think we're going to make it.
Yeah, I think I totally agree with you. I think the very essence of what this space is about is the ability to maneuver and to experiment, and it doesn't have to be illegal. It doesn't have to be illicit.
No.
It can be. It can be a creative process, and we need that process to play out. And it's going to be really interesting to see how the space evolves over the next. I think we've got the next 2 to 5 years will set a precedent to where we will arrive. That's my opinion on it. It'll be interesting.
And RWAs, just to kind of circle back to that point, right? For RWAs to really work on chain, we need an order of magnitude increase in, call it, capacity of blockchain transaction speeds and decreasing cost. So if those two things happen, then tokenizing what are currently securities, whether they be debt or equity or others, starts to make actual economic sense, because it's just better to run them on a decentralized blockchain than on some kind of decentralized database. But before we get to that, that's going to be this cycle. And then once that happens, we will have tested enough and played enough with it so that we can actually do it. Whereas if you were to try to do that at a cold start at that point in the future, you couldn't do it. So it just takes time. Rome wasn't built in a day. This will happen over time. The next cycle will be very interesting, but we're still at the stage where we're trying stuff out in an environment that is not yet at the efficient frontier where it needs to be in order for it really to work at scale.
Thoughts on Solana?
Yeah, so again, to me, this is very interesting. As a practitioner, having come into the thing when if you wanted to build, you built on ETH. And all of this other stuff were still kind of, esoteric, brain farts by people who are way more technical than I am. And what you're seeing today is that a bunch of these things have actually come to fruition. So you've got some, pretty capable layer 2s on ETH. You've got some alternatives to the ETH layer 1, whether that be Cosmos or Near, or and in this case you've got Solana, which is a slightly different philosophy, but just very interesting, trying to solve the same problem, the blockchain trilemma, in a different way. And what we need is more people tinkering away at that very same problem, right? And I think there will be multiple solutions, because the trilemma by definition means you're optimizing one over the other two, or two over the odd one out. And so that optimization happens with a goal in mind. And so if you have different use cases, you have different optimal states of the solving of the blockchain trilemma. And so thus, by definition, I think what you end up with is different ecosystems that solve for different types of problems. And so, to me, it's not about the modular versus monolithic or all kinds of those design things. It's about, once we get these things, which I think they're not yet, right? But once we get them to a place where they can actually compete with a centralized database on cost and transaction throughput, then we need to kind of optimize them for certain use cases. And I think that's what you're starting to see now, right? With Fire Dancer, by Jump Trading, optimized for kind of, order books, and Serum was a kind of early precursor to that on Solana in a weird way, right? So Solana, I think, will probably get a lot of that, call it trading stuff, and use cases that require enormous amounts of speed and incredibly low cost. There will be other use cases that fit better with the Ethereum philosophy, which is possibly a little bit more skewed towards security and having different layers, so that there are different, call it, if one layer fails, then the whole thing doesn't go down, which obviously in Solana, if it goes down, it goes down. So to me, this is all still to be discovered. And the great thing is that all these teams are getting more and more very bright, very young, very motivated people involved in their cause, and we're making huge progress, right? I mean, even over the period that I've been actively building the last 2.5 years, I mean, the progress has been immense, right? It's not that long ago that Ethereum was still proof of work. People forget. People forget. And I remember when we built the first version of our protocol, and we were putting these loans into these vaults, and it would cost me more money to put the loan into the vault in terms of gas fees than I could possibly, but all of that now, on Arbitrum, now it's starting to work. And I would argue we're still one order of magnitude away from where it's symbiotic. And then the next really big issue is, making it so that normal people can, interact with these things, protocols, apps, whatever you want to call them, in a way that doesn't expose them to the amount of risk that you are exposing yourself by, being on chain today. I mean, the amount of scamming and stuff that happens, so that you need to be so careful of when you're dealing with self-custodial assets is of a scale that it's good that not everybody talks about this and not everybody knows about it, but we need to do something about that before we can open it up to the masses.
Yeah, I think it's part of the process. I think it is happening. I mean, we obviously get to see a lot of the interesting innovation. I mean, we're speaking to a protocol at the moment that's developed essentially a wallet that allows for self-custody through your CPU, and it can't be accessed by anybody else. It's hardware specific. It's essentially safer than a hardware wallet, and that's what's happening now. I mean, this is technology that's been essentially developed over the last 2 months. So we will get there. There's no doubt that we will. That whether we will or we won't, we will.
Yes.
And I think that essentially all it is what a time to be alive. It's like really
totally.
it really is like awesome from that perspective. And I think that a lot of these problems are going to get solved or are being solved, and those are going to be, those are going to be the people that are going to take this space forward. And as far as I'm concerned, it's not whether it's going to happen, it's just when. And it's great that we obviously get to sit at the fireside and see this thing unfold, and it is, and you guys and us and everyone involved is contributing to this whole kind of melting pot. So thank you for your time, sir. Where do we find you guys? Where are you out there? Give us a little bit of detail. I will post this obviously below the interview on YouTube. So if anyone is listening on a podcast, it will be in the description on YouTube, so you can check it out. Where are you guys? Where do you hang out mostly, and where can people find you?
All right. So we obviously have a website, www.florence.finance. We have Twitter and Telegram. Twitter is @FinanceFlorence, so the other way around. Somebody had scooped Florence Finance before we could get it. We'd love to have that back, so if you're listening. And if you're really keen, then you can obviously join our Discord, where there's all kinds of chicanery, but that's for the degenerate among us. But that's how you can get in touch with us. Right now, like I said, there's this big kind of onboarding program. We've got very cool NFTs and community incentives going on. We'd love to get a lot of people on board with that. And the more you learn, the more feedback you can give, and possibly even participate in the token launch in the next couple of months. It's going to be a wild ride, and we're really excited about it.
Cool. Really good to meet you, sir, and thank you for your
Likewise.
time. Love the passion, love the perspective. Great to see that you're not a maxi. You're open to everything that's out there. I think that's really important, and it's super healthy. And I sincerely wish you guys the best. And we'll see you guys out there. We really enjoyed getting that article out. So we did do an article on Florence. So if you guys are interested in reading some more, I will link it as well in the description. And please, guys, like, subscribe, send us a bit of love. We do appreciate it. Thank you, sir. Have a good one.
Thank you. Bye-bye.
Ciao.